Hi, everybody, and welcome to today's panel. We're going to be talking about venture capital flows. So looking at the state of venture capital as it is today here in 2025 and where the money is flowing or perhaps where the money is not flowing. So I'm joined by four incredible panelists and I'm lucky to really sort of know each of them. So I think we're in for a really fantastic discussion today. But starting off, we're going to be joined by Ariel Eck. And Ariel is an LP, professional LP investor with Siegel Ventures, which is a family office. We've got Joe Harkins, who's an LP and executive at X2X Media Group. We've got Robert Dunn, who's an LP and a partner at HI Executive Consulting. And we've got Sarah Fu, who's a GP at Elsa Capital. So Sarah will be representing, the more GP side of things here, with our other three a little bit more on the LP, meaning they primarily are investing in venture funds. Although I know, they're also doing occasionally some angel or direct deals as well. So I'd love to, maybe set the scene by asking each of you how you'd characterize the state of venture capital here in 2025. What feels a little bit different versus how things were, over the last few years? And are there any words or phrases that you feel, kind of capture the current mood? So, maybe we can kind of do this popcorn style or, feel free to jump in. But, Robert, you're nodding your head. So maybe we'll start with you. I know you've got some good thoughts here.
Yeah, I do have little words. So hesitant, uncertain, more evidence required, product, more traction. And then one other I'd add is nobody wants to look stupid again.
Yep, absolutely. Anybody else want to weigh in?
Yeah, I'd say there's sort of a recalibration after sort of a frenetic pace a few years ago. Now things are more disciplined and yes, looking for more profitability and sustainable growth.
Yeah, I would second what Ariel just said, and also Robert. I would say right now is time for a more disciplined approach, and that's what we're seeing. And I think as LPs and investors, that's what we're looking for as well.
And I would add from the GP side, definitely we are seeing like a lot of noise. So I kind of see it as our job to trying to find the signal in the noise. So it definitely takes like a lot of judgment. So the market overall, it is pretty hot, but it's not as crazy as during the COVID era. But there are obviously also pockets that are like extremely like crazy. So it definitely takes like a lot of like work and diligence and judgment to pick the next winners.
Yeah, absolutely. Well, maybe we could jump into that point that you made, Sarah, just a little bit more. I'd love to hear, like, what do you think accounts for a lot of the noise in the market today?
I think the noise just naturally comes with like any like technology wave, right? It comes from like fundamental just like human psychology. Whenever there's like a big technology, I think like generally you will see like it gets like overhyped like initially, and then it becomes like underhyped. So I think like sort of when the ChatGPT first came out like 2 years ago, everyone has this like, wow, like this is like possible. And suddenly like you see like all the startup forming, there are like so many demos. And then there was like the first year, everyone's like so excited. But then basically once the demos actually get to potential customer, then customer are like, a lot of them are like underwhelmed. It's like, oh, it looks good on demo, but when we actually like try it, it literally like doesn't work, right? And for like potential customers, like especially on B2B side, like people are like very busy. So they don't have time to just like take like 10, 20 potential meetings. So after a while, people literally like get burned. They're like out of these startups, like, are there like anyone that is like actually real? And at the same time, like everyone knows like AI is like next big thing for like any industry. So no one want to like literally like shut down the door saying I'm not meeting like any potential AI startups. So they're basically in this like tricky situation. They have like a lot of like doubt, like hesitation, but then they really want to find like the high quality AI startups. So I think that's currently the phase we are in. There are definitely a lot of noise. When I get onto like call with founders, like I often go through like product demo, and honestly, there are a lot of product demos that don't quite work. But sometimes I do see like just really like a truly like 10x, 20x product experience, and that's what made at least my job super fun.
Oh, that's great, and yeah, definitely resonates. And I'm curious from the LPs, Ariel, Robert, Joe, are you seeing a lot of noise on the sort of fund side as well?
So go ahead, Ariel.
Yeah, I mean, I think every company and in many cases every fund is investing in AI at the moment, and so it comes down to scrutinizing that a bit further and understanding, are you investing in the infrastructure layer and the data, or are you looking at vertical specific applications and digging a bit deeper into, if there's durable companies with scalable competitive advantages and not just that flashy quick pitch or early success. But a big part of the reason that we invest as LPs rather than angel investing is because we're trusting fund managers like Sarah to do some of that diligence for us to help dig in on the company level. And so we really have to look at our fund managers and trust that they have the expertise either themselves or with technical advisors on their team to suss out the noise, I suppose.
Yeah, I would add that I think nobody wants to look like they don't understand what's going on in AI. So I think there's a lot of funds that actually really don't. Like Sarah's completely focused on it, right? So she has to understand it and has a background in it. I talk to other funds and I don't get the feeling they really do, but they sure don't want to look like they don't know what's going on. And so I think that's a weird dynamic. Meanwhile, I think there's some, kind of older school sectors that, because they're not flashy, they're getting missed and they're actually good. I think the insurtech sector is going to be huge, but it is not flashy, right? You still have to do all the hard work, but it doesn't have, there's not as much of the signal and noise, I think. So if you're going to go into a wave, you have to really, really be careful. And either, like Ariel said, you have to trust someone who's doing it, or if you're doing it also, you just have to be super careful and not get sort of bamboozled.
Yeah, I think that's a great point. It's everybody loves to move, kind of jump on a fast moving train. I remember there was a point when, and I'm sure it's still happening, where you're seeing a lot of, once crypto funds now becoming AI funds, and everybody's sort of trying to jump on the bandwagon. So yeah, maybe we'll move on and talk a little bit about the flow of capital. And I should have, prefaced all of this by also saying, we're going to run this panel for about 35, 40 minutes, and then we're going to jump into some Q&A. So feel free, as we're discussing, folks in the audience to, start populating questions you have into chat as those arise. But we'll also have an opportunity if you want to, potentially raise your hand and come off mute to ask questions as well in a bit. So yeah, I would love to hear from each of you, where the capital is actually moving today. So again, from our LPs, Joe, Robert, Ariel, from your perspective, like what categories or themes are attracting attention? Obviously, AI. Anything else that you're seeing, or are there any sectors that have now fallen out of favor? Yeah, we would love to hear your thoughts there.
Yeah, I'll hop in here real quick. One of the areas I focus on, as you know, Sam, is enterprise SaaS, and that's obviously always in favor, it seems like, but it's certainly transitioning with AI, and it feels like AI is a disruptor as opposed to just one of these trendy keywords at the moment, right? So, really, really looking for that kind of extender of enterprise SaaS, if you will, like who's adding technology that's going to disrupt the current infrastructure. I think Ariel said applications, data layers. Those are kind of the layers that are interesting. And people like Sarah are making those plays from the investment side, which makes it pretty interesting. I feel like, you mentioned crypto and Web3, stuff like that. Things come in and out of phases of trends. I think the regulatory hurdles and the different complications that occur with technology can be big hurdles to these disruptors trying to make big waves in the market.
Absolutely. Robert or Ariel, other thoughts there?
Yeah, I mean, I think in addition to SaaS, we're excited about some of the opportunities we're seeing in healthcare and continued innovation around personalized medicine, diagnostics, things like that, especially women's health. We're seeing some interesting innovation in deep tech and robotics around supply chain and manufacturing, and then fintech as well around risk and fraud protection. So those are, in addition to SaaS, some areas that we're excited about.
I would add, Sam, an area that I think is going to be enormous and is starting to sort of become clear now is innovation in defense, right? The whole, I mean, the fund one of the funds I'm in that is doing the best, they're just crushing it because everything is focused on technological innovation in the defense sector. And I think all the trends sort of are going to be tailwinds on that. You have concerns of, China taking over Taiwan. We have an active war between two large countries. The defense sector almost seems to be waking up, as if 1989 ended everything. But now all the technology and innovation was kind of gone. So you have new movement in there. So I think there's going to be a lot of things in that sector. I think also, even in existing sectors, anything that helps simplify stuff, like take security. Security, my God, I can't even keep up with all the products and companies in security. So I think there's going to be opportunities for products that come in and say, we know you have to do this, but we're going to make this a lot simpler for you, increasing the value in a way that the existing products maybe don't.
Love it. Yeah, I mean, I think what I'm hearing from everybody here is that, really when it comes to AI, a rising tide sort of lifts all ships, and it's really starting to touch so many different verticals, creating, really interesting why nows from everything from healthcare to deep tech to, to SaaS. And Sarah, from the GP perspective, I'd love to hear where you're seeing venture dollars flowing. Obviously you kind of focus at the intersection of fintech and AI. But yeah, curious to hear, from you what you're seeing, and then if there are any, differences between, say, kind of pre-seed, seed where you're playing, and sort of the later stage Series B or above.
Yeah, definitely. So I think I would probably like answer that in like two different levels. One is sort of like by sector, and then the other is by stage. So I think from like a sector perspective, like maybe let's like zooming back, right? Like we look at like the GDP. A big reason why like I focus on the fintech sector is because like financial services, professional services, it is like so big. It's like over 20% of the GDP. Like everyone hear about like tech, but tech today is less than 10% of the GDP. So it just like put things like into perspective. Like we have like giant industry, like finance industry, like construction, like defense, that have barely been like innovated for like the last 15 years, right? I was like catching up with some friends at like Goldman Sachs. I was like, how's like the internal tooling at Goldman Sachs? And if you ask about those like large banks, like literally like the last real tech innovation was back in like Microsoft, like in 1980s. So it just like speaks to sort of how these like huge industry, they haven't been innovated for decades. And now there's like huge opportunity, not just like in finance, like insurance, but like construction, industrial, a lot of these core foundational industries. The second part, I will answer your question on sort of like stage, basically how AI today really affects the different stages of venture dollar. So I think like it really benefits like two stages. So basically pre-seed and seed, when things like first getting started, you always still need venture dollar. And then for later on growth stage, you will still need venture dollar to like expand your go-to-market, to scale up after product market fit. I think right now where it's challenging, where we are seeing less and less is Series A. And a major reason is now because like AI company, once you get to product market fit, literally you just take off, right? Like you go from like 1 million to 100 million in like 2 years, in a year, and then literally you just like bypass that Series A phase. So I think right now we're seeing a lot of Series A company basically just moving earlier and earlier towards pre-seed and seed. So basically I think that sort of like affect how like the venture dollar is shifting. I think another aspect for a lot of those like growth stage company is basically how big the growth round is going to be. Historically, we see a lot of like large multi-stage firm, like they are pretty used to giving like 100 million, 50 million checks. I used to run fundraising at Stripe. So we see like a lot of those like giant term sheets from like multi-stage firm. But I think the big question is like now with AI, like firms can become a lot more efficient, right? Like, do you still need like a big engineering department of like 500 or 1,000 people, or can you do the same with a same engineering team of like 50 people? So I think like the growth stage, like definitely there will still be a lot of needs for capital, especially on the go-to-market side, because like sales, eventually you still need a human being to sell to a human being. But I think there's just going to be so much capital efficiency in this new era of AI native companies.
Great point. Yeah, I mean, there's such interesting dynamics that are starting to play out now in the markets, which also leads into my next question about kind of talking a little bit about risk, right? We're seeing, very turbulent markets. We're seeing rapid policy changes. So I'm curious, maybe Sarah, we can stick with you for a second. Do you still feel GPs are willing to take risk, or are people tending to sort of play it a little bit safer given the slightly more turbulent environment we're in today?
I think that's definitely like a good question. So I would probably say there are two types. So one is sort of like emerging managers. Like obviously we have to take risks, right? Like I'm not hiding, like I'm a first-time fund manager. Like if I'm not here like taking risks, trying to like find the next stripe, like I'm not going to have like a successful like fund franchise. So for me, it's sort of like the bread and butter. We have to be there, like taking risks, finding like the next stripe. I think there are some fund managers, especially at like some like larger fund. I think there are like I have like a lot of friends who are like GPs at some like multi-stage. I think people are maybe like it's not taking less risk, but people are sort of taking more a wait and see approach for things to like pan out a little bit. I think for some of those firms is you make fewer bets a year. For example, like for me, I probably invest in like 8 companies, right? So I can be like more active. For a lot of these other GPs, maybe the entire firm like only make like 10 bets, 8 bets a year. And we're talking about like 10 billion AUM VC firm. So for each individual GP, he literally like only has like 1 or 2 punch card per year. So for him, it makes a lot more sense to like, oh, let's wait out the tariff. Like let's meet more company until I absolutely find the company. That's like a 12 out of 10 for me. But I think like for me, I'm seeing plenty of like very exciting early stage opportunities.
Amazing. And Ariel, how about you from your perspective as an LP at a family office? How are you guys thinking about risk tolerance in terms of new investments and re-ups?
Yeah, I mean, I definitely think that every family office is different, right? And there's struggles in terms of liquidity right now, but we see venture as an asset class as sort of a nice place to be right now because you don't have to worry about sort of that volatility in the public markets that we're seeing at the moment as closely because you're sort of locked up for 5, 10 plus years. And so at the moment, it is a little bit difficult for us to re-up because a lot of the funds that we've invested in are still early on and haven't necessarily seen the DPI or TVPI. And so I'm a little bit more inclined to be looking at new investments that can sort of round out gaps within the portfolio. But we really have to be incredibly stringent and diligent about funds that we're investing in and up our diligence process when it comes to emerging managers to make sure that there's a really strong, fund manager thesis fit, that there's a really strong value add, that there's team alignment and sort of defensibility, and that they have sort of a right to win within what they're operating in.
Makes sense. And Joe and Robert, from your perspectives, you guys, as sort of individual LPs, maybe don't have the same type of mandate that maybe a family office might. But curious to hear, how these like macro fluctuations, affect your personal risk appetite, and whether are you concerned about the day-to-day fluctuations, or are you, sticking to kind of a predefined allocation strategy?
So yeah, I'm not so much worried about what's going on in the markets day to day. If you're taking a long-term view, I am very concerned about liquidity, and not to be overly simplistic, but none of this matters if the investment isn't eventually liquid. And I am still surprised how many founders I talk to, companies I advise, emerging managers, and even later stage funds. They don't have a good answer for that. They don't have a compelling answer to that. And I do think something that Sarah said earlier, I don't know that there's been a real reconciliation of the fact that building new companies is going to look slightly different from a capital efficiency standpoint. And what does that mean for exits? So I would say if there's one thing I'm particularly focusing on, do I believe there is a compelling path to liquidity? And then I back into the market, the product, the team, and things like that. And then I'll take on tons of risk. But if I don't feel compelled by that, I would just rather throw it in Berkshire Hathaway, frankly.
Yeah, it's a very good point. And Joe, how about you? What's your perspective?
Yeah, I agree with Robert actually quite a bit. I'd say the day-to-day market fluctuations I'm not really looking at, don't really want to pay attention to. What I tend to look at from the macro environment especially because my background in corporate development is what is a merger and acquisition activity with strategics? What some of the capital flows of private equity as well, and just looking at what are the moves being made, what are the companies that are getting rolled up, why are they making those decisions right now, what is it that they see in the market, and how is that adding value to their overall portfolio. So I look at the M&A market quite a bit, and then also the IPO market, right? So won't mention any companies, but there's been a couple good IPOs recently, which I'm happy to see that the IPO market seems to be having a bit of a comeback. And so maybe that's also a good sign, because one of the things, like Robert mentioned, liquidity, one of the potential exit scenarios is an eventual IPO. It's not, very common necessarily, but it is one of those pathways, and it hasn't been open now for a few years. To see that kind of re-emerging, I think is really nice. So those are kind of some of the things I'm focused in on.
Yeah, perfect. I think we've all got our fingers crossed for more IPOs coming up soon. And that's also, a great lead into sort of the next section that I want to talk about, which are kind of more sectorial or structural shifts that we're seeing in the market. So one of those shifts that I think we're all fairly have a vested interest in is the rise of kind of smaller emerging managers. And we've been seeing from the data, right, that smaller emerging managers tend to outperform. But I'm curious, to hear from all of you, is this a trend that we think is going to continue, or are we going to continue to see more smaller funds, persisting, and, kind of why or why not? Is this a trend that's here to stay?
I'm happy to volunteer first, Sam, if you want.
Yeah, please, Robert.
I want to say yes, it will, but I really think, if I think of someone like Sarah.
Robert, you might be cutting out a little.
Sorry.
Can you hear me now? Yeah.
Can you hear me okay?
Okay, there we go. Yeah, I think you're back.
I think it's going to be super important, the quality of the emerging manager, because the barriers to entry aren't that high, really. And so I think, on one hand, I think it's going to continue, but I think we're going to have quite a few that don't make it, and it'll take time to figure that out. The other thing, I think that there's not, and when I speak to founders, I advise a lot of early stage companies, there's not enough clarity coming from pre-seed and seed funds to the early stage startups of what the investment criteria really is. Like Series A has been hammered out for decades, right? But now that we've moved earlier and earlier, so is it just an idea? Do you need to have a customer? Is it beta? And I think that's another thing. If it's going to remain viable, if it's going to become a critical piece of the fundraising journey, that stuff's got to get hammered out better.
Mm-hmm. And Sarah, I'm kind of curious for your perspective on this too. Obviously you're squarely in this camp as a kind of new emerging manager. What do you think your advantages are today over some of the incumbents?
Yeah, so I would say there's like a few different things. So one is sort of just the ability to like move like quickly. I think we talk about there are some like large multi-stage, you don't know where things are, like you wait forever. And I think like for me as like a solo GP is like I tend to make decision like fairly quickly. And two, I think it's more like sustainable is like there needs to be some real value add to the founders, right? It's not like just a dollar, like dollar is a commodity, right? So I think like for me, basically what I bring is I do bring a lot of like operational like expertise. Like I work at Stripe for 4 years, help grow the company 20x in product, in business. So a lot of time it's like founder, like they will look up like my LinkedIn profile before taking the meeting. And then they're like, oh, like love your Stripe experience. Would love to chat more. And then they sort of like use the meeting as like a half like pitch. And then once they see I'm in their camp, then like they started to like sort of like use my brain, like to advise them on a bunch of questions. And the other way, like I really try to like help founders is with like customer introductions, specifically like introducing them to like enterprise customers. And honestly, like I would say like there are like a lot of like VC firm that do not have like the network to actually help with like customer introduction. So I think like it's really important for like emerging managers to like have some like unique like value add. Clearly, like I do not carry like the brand of like Sequoia, but like I could actually get you into the door of like a large enterprise financial services customer that is worth as much as Sequoia in your end customer world. So there just needs to be like some like unique things like we can offer to the founders. And I think that's basically being what's being super helpful for me. The last thing I would say is, I think everyone knows like venture is a very relationship-driven business. So ultimately, if you are a really top founder, like you are literally like picking people you know, picking people you trust. So that specifically in the case of me is like, I know a lot of people from my Stripe community, like people I've worked together for several years that know who I am, not just as an investor, but just like, even when we were like back as colleagues, this is who Sarah is. Or it's like people I know from like Stanford, from business school from like 10 years ago. And back then, like I didn't even work at Stripe, right? Like they know who I am just like as a genuine like human being. And I think for a lot of like top founders like out there, like if you are really hot startup, like you get to pick your VC investors, right? So for them, literally, they're like, okay, like obviously I could get like the Sequoia and Jason brand, but like how do I want to round out the cap table? Who are the people I'm generally going to pick up the phone and call when I have like a real challenge? And I couldn't say just like how many times I get on a call with founder, and founder literally says like, oh, like I feel comfortable sharing this with you because like I see you as like a trusted friend. And honestly, I wouldn't like share these challenges with a lot of other investors. So just like having those long-term relationships and being a genuine human being, I think also makes a difference.
Yeah, no, that really resonates. I feel like I constantly see founders who really want, that sort of sector expertise and sector experience from investors, and then just overall the trend of kind of individuals over institutions. So yeah, definitely think you're well positioned. And then I'd love to hear from our LPs. We spoke a little bit earlier about the noise in the market, and as it comes to lots of smaller newer GPs getting launched. What are the best GPs doing that's attracting your attention? Curious, what you're seeing that really stands out and helps a fund kind of stand out from the crowd.
I can hop in here real quick. I think actually a lot of what Sarah just said is exactly what, as an LP, you're looking for, really, like a domain expert that has operator experience or some kind of unique background, right? That lends to not only their credibility but their ability to have value add beyond, the dollars, which, as Sarah said, are commoditized, right? So looking for those emerging managers that are the value adders, finding them, identifying them. They have a track record usually in some way, some form. It doesn't have to be, venture track record, but some kind of track record. And you kind of get this sense that they're going to persist, right? Because it's ultimately a 10-year plus relationship that you're looking at doing anytime you're investing in a GP. So you want to know that this person is motivated and has a unique value add that they see themselves fitting in, and that they have great deal flow, which will help them execute.
I would echo that and reiterate that, there is a long-term relationship here. And so for that reason, you need to be thinking about things like the transparency and authenticity of people who are open about challenges and communicate clearly and have really passion for the work that they're doing, but they're people that you can trust in the long term. People with discipline who are going to stick to their thesis and not get distracted and have a clear plan about how they'll deploy their capital efficiently, but also judiciously, to maximize returns. And then I think also team alignment. And so how fund managers' teams work together in the face of challenges, taking accountability, learning from mistakes, in addition to, of course, that value add being like the first thing that I look for sure.
Yeah. No, I think it's such an important point and kind of follows up on what Sarah had mentioned earlier, that, venture is just such a relationship driven business, right? And so I think GPs, you can have a great thesis, but, the really important thing, right, is that you're conveying transparency and trust and able to build a real, relationship with your LPs going into the fundraise. So yeah, really, really great points there, Ariel. And then kind of doubling down, I guess, on the AI discussion, would love to, kind of dig in a little bit more because it's just such a massive, kind of current in the market today. Sarah, I'm curious, like, are you seeing, like, does every company need an AI story? Or how do you think about it? Obviously, you're focusing there, but do you think, if a company doesn't have an AI story, they're going to just really struggle to fundraise?
I think the answer is yes. But I think I would sort of like peel off the onion a little bit, giving like a more sort of a more detailed answer. So basically, the way I look at the world is that there's obviously like AI native companies, and these are companies just founded over the last 2 years. So generally, like they started the company to build on the latest like GPT cloud, like Gemini stack. And then there are another type of company, they are sort of like AI adjacent. So they could be traditional like enterprise SaaS, like Joe was like alluding to. So those were company like they could found it like maybe 4 or 5 years ago. And back then, like there was like not like the GPT we talk about today. But today there could be a special why now moment because of AI. So I'll give you like a very specific example. Like very recently, we're probably going to invest in like a procurement company, and they are like the typical traditional SaaS, like CFO software stack. But now they have a very unique like why now, because like with AI, companies suddenly care about two things. One is they care about all their data security, because like suddenly everyone buys these like AI tools, and then they literally use their own personal credit card. They don't even go through the company approval process. It's just like, I'm paying out of pocket so I can save like 5 hours, but you are all using the company data. So suddenly the company is like, oh, like we actually care about all our data that going through like all the different like AI vendors. So let's actually start a procurement process so we can actually see what are all the different like AI vendors that are potentially like using our data. So I think that's number one. Number two is I think now with the proliferation of just AI tools in general, for a lot of company, they are actually thinking about sort of slowing down headcount or not even increasing headcount. And instead, their thing is, we definitely have more things to do. So let's just buy in more AI tools or just more tools in general, and we're going to slow down hiring. So what that means for the procurement department is suddenly I think the HR side has less work to do, but the procurement department suddenly have more things to do because you are onboarding more tools. So in this case, it is a traditional like enterprise SaaS story, but there is a unique like why now because of AI that's going to turbocharge in the next chapter of growth. So I think either you either need to be AI native or you have a special why now because it's related to AI.
That makes a lot of sense. And Joe or Robert, would love to hear from you related to sort of AI budgets and such. I'm curious, are your respective companies experimenting with AI? Just kind of curious to hear from sort of on the ground operators, whether you're seeing live kind of budgets being allocated to some of these new tools.
Yeah. So, I mean, one way I'd answer that question, Sam, is one of the searches I had to do was for an $80 billion fund, which I won't name, but they had to build out AI expertise because literally every single one of the portfolio companies didn't know what to do and had questions and was in concerns. And so in that process, we had to talk to a lot of the top tier AI folks out in the market. And I definitely, there's more money going to it, but I think there's still, so where should we spend the money? Like you can decide you need to invest in AI. I think some companies are still figuring out exactly where to invest. And increasingly, I'm hearing they need to know that there really is some kind of savings before they do the investment. So at HIC, we're doing some, not as much, but companies I speak to, they're all trying to figure this out. They all want to make investments, but they're not always certain what the investment should be, how much, and what do they really expect to get from it.
Mm-hmm. Great point.
I would agree with what Robert said as well. I'm kind of in the same boat. I would say one thing that was more of a reaction was just kind of putting in place policies, right? Making sure you have global policies for all your different offices and employees to follow so that when people have questions, they have somewhere they can go and look for that answer rather than coming in later and saying, oh, I'm using all of these new AI tools. Maybe I should tell you about it, right? Which
Yeah.
it does happen, but you really want people in the enterprise to be kind of invested in sort of the culture of whatever the policy might be. And so I think just having a policy, having a company MO from the top down really does help. And it helps guide people in terms of like, well, what's accepted? How much risk are we really going to take? Are we looking for cost savings? Are we looking for efficiencies? Where is it that we're trying to deploy AI? Right. So it just depends on the business and kind of where they're at as well. I think in terms of their size and their overall, kind of like speed of development too, right? Because some companies move really fast and have to react really quickly, and others can move slow. So it just depends.
Yeah. So it sounds like you're both seeing it, but we're also still in a little bit of a discovery mode at larger enterprises. Makes sense. So we're going to do two more questions, and then we'll move to audience Q&A. So audience, feel free to get your questions ready. Ariel, I want to make sure to include you here. I'm curious from an allocator standpoint, are there ways that you're leveraging, new tools and in terms of AI or data to improve sourcing or picking?
Yeah, absolutely. So, I mean, we're certainly using AI for deal memos. We're currently undergoing a rehaul of our CRM to sort of enrich our data about our portfolio as well as, our pipeline in terms of gathering as much data as possible about every GP, whether that's, their education, their geography, cohort programs they've been a part of, like VC Lab, and building out sort of a rubric to assess those potential investments based on different weightings. And there's ways to automate that pretty easily via AI. The other thing that we're working on is using AI to sort of create more of a portfolio health scorecard to more easily sort of digest where everything is at without having to manually go through all the different updates from all of our GPs.
That sounds like, yeah, so it sounds like you guys are really doing some stuff there that makes a lot of sense. So as a final question, I'd love to kind of end with a little bit more of a hypothetical, but if you could wave a magic wand, what's one thing that you would change about today's venture ecosystem? I'll give you a moment or two to collect thoughts, but if anyone brave wants to jump in there, curious for your thoughts.
I would love that there wasn't as much capital required. I think capital's been so available that everything has over rotated to taking in too much capital, getting to an exit velocity of 100 million ARR, et cetera. I think we got to recalibrate that. And I think we're going to lose a lot of particularly good, promising little companies that could make it if we could just adjust this back down some.
Yeah,
Makes sense.
I would kind of agree there with Robert, actually. I think some of that is these really large, prestigious funds that are now, multiple funds later at such a size that the capital they're deploying is so large. It's sort of like gravity. It takes up all the air in the room. It sucks everything in. And, there's sort of a spray and pray method applied when you're that size, right? So you are going to win because you're basically playing every number on the table. But you are taking away opportunities maybe from some smaller emerging managers. So I think the interesting thing is that where the emerging managers are finding success, I think, is by being the domain experts and actually having some value add. Whereas large funds, typically it's just a lot of capital, and they might have multiple people assigned. They might have a bigger set of tools to work with, but they might not have that niche kind of expertise and that certain level of value add that these small companies are looking for. And this also goes back to something Robert said, where right now is a good time to be looking at small teams that are not as capital intense, right? So, ideally, you shouldn't be a company of 50 or 100 people as a startup, in year one, right? You should be maybe 3 people, 5 people. And you see these companies that are scaling with 10 or 12 people, and all of a sudden they're getting to 50 or 100 million ARR. That wasn't possible 10 years ago. So things are definitely changing, and it feels like the market will hopefully shift around in the future to kind of adapt to that.
I think in a different lens, one of the things that we really believe strongly in is that there should be greater inclusivity and representation within venture, and that speaks to um, access to capital. And so we believe that there's really tremendous untapped potential with female fund managers and other underrepresented fund managers and their ability to create outsized returns because they can identify overlooked opportunities. And that remains stronger than ever. The data consistently shows that these businesses are generating higher ROI and these funds are returning. And so, even if they're receiving less funding, we believe there's tremendous opportunity there. And I would love to see more folks taking that approach moving forward.
And I will just piggyback to what Ariel said, taking a different lens is more like women founders. I think there are sort of two-part. One is like only 2% of LP dollar goes to women GPs, but another part is only 2% VC dollar go to like women-only founder teams. And sadly, that stats haven't moved since 2017. And before starting Elsa Capital, I was a founder myself. So like I know like how lonely the journey could be, and really like there are a lot of amazing women founders like out there, and I would really love to see just more amazing women founders build amazing companies. Another quick thing I would add is I generally hope like there are more like VC funds actually like care about the founders and like rolling up their sleeves to like help founders. I think if you actually talk to founder, they would say like a lot of VC firms say like the same like value add on their website, but it's like actually very different in reality. And sometimes it just kind of like I get on a call with founder, and founder literally is like, oh, thank you for taking the time to just sort of brainstorming this with me, like having this honest conversation with me. I'm like so grateful for this. And I think on one hand, I'm like so flattering, but on the other hand, I really feel like other people on the cap table are doing the same, because the founder journey is very hard. And I really hope like more like GPs could really like genuinely care and help founders in different levels. And that's just going to, I think, make it a better world in general.
No, it's such a strong point to end on. Yeah, love all of those points that you all have made. So we're gonna move into Q&A. We've had a couple. Hopefully, I've been able to catch a bunch that were in the chat. But also if you've got a question, you want to raise your hand, we're happy to call on you. Maybe we'll start. I hope I don't do a bad job interpreting this question from Pi, but a little bit of a I guess a leading question, but he's basically saying, why do VCs and GPs kind of neglect macroeconomic and geopolitical conditions? Could the lack of distributions really be more of an issue related to, the unprecedented debt levels and things like that? So I guess like maybe we can reframe this as a question around, do you think that GPs overall are paying close attention to these macroeconomic and geopolitical conditions? And if they're not, what might be the thought process there? Not sure if anybody's got a opinion on this one.
I mean, I think it really depends on the GP, right, and what they're working on. I think that, we have some fund managers that are focused on things around supply chain, and obviously global tariffs play an enormous role in things like e-commerce and supply chain. And so they're paying very, very close attention to those things. But I think that others, certainly there are some who have a little bit more tunnel vision of what they're working on and aren't necessarily thinking about how that can affect their portfolio. And so I think I assume, to his point, they would be wise to be thinking about those implications. And almost every fund manager in our portfolio has commented on the role of the macroeconomic environment in their portfolio, but some are digging in much, much deeper than others. And so we do notice that.
Makes sense. And also, I think in the space that a lot of us play, right, and sort of pre-seed, right, the time horizon is just so long that, maybe you can, afford to sort of not think about some of these things quite as much as somebody who's investing, say, pre-IPO, where the exit window, is going to be at a much, sooner time frame. So then we had a question from Chandler about whether we think that sales will continue to need to be done person to person, or with companies like 11 Labs, is that going to evolve?
I'm happy to at least give my quick comment on this, Sam. I think part of what has to happen that will take some time is those who have built their careers on being sort of the enterprise Tom Brady, for example, as CRO of some famous companies, and then they wind up in the funds. They are in my experience, they're very resistant to this. It's just impossible for them to face how much of this can be replaced. I do think there's some things that support will make it a little easier for the trend, product-led growth, cloud marketplaces. There's a lot of trends in the direction that I think will facilitate it. My own view is the sort of the ACV or the deal size that a human has to be involved in will just keep pushing up. There'll always be some deal that a human, but I personally think it's going to before long be past $250,000 to have a human involved.
Interesting.
Yeah, I would agree with that. I think the larger the account, the more you want someone you can talk to. And I think as an enterprise and kind of from the operator perspective, you almost want someone you can kind of pin down and blame when the enterprise that you have a large contract with isn't necessarily doing exactly what you want or how you perceived, the customer value was going to be created there. You always want that feeling that you can reach a person, right? So certainly as the account sizes increase, and I think that's kind of what Robert's point is, like eventually, some of these purchases will just be things you do in an automated way. But once it gets over a certain dollar value, and that dollar value does creep up, you do want people you can deal with. It's just kind of the nature of things.
Absolutely. And then we had another question from Fong. Ariel had sort of answered this a bit earlier, but he's asking, or Fong's asking, how are we incorporating AI into the diligence process? So I guess that could be related to, diligence of individual companies or of fund managers. Anyone here doing anything interesting?
I mean, I think it just speeds up the process tremendously and enables us to gather information very quickly in a way that normally we would have needed an, associate or an analyst to be able to do. I don't think we're doing anything necessarily revolutionary, but I would caveat that, the more that you customize your prompts and queries, the more helpful the results are. And so, inputting the weighting with which you value different components of an opportunity will be critical versus just sort of a generic diligence process.
Got it.
Sam, I know the question was more due diligence, but I would just say I know I imagine Joe's the same way. There's so much inbound from startups and emerging fund managers, etc. I actually kind of go human back on them just to see if they can really respond. Like I'll do a truly handcrafted quick email or response on LinkedIn to see can you actually handle that? So I realize that's different than what Ariel and Sarah's, they're kind of in a different sector, but I think you're going to have both because some of the AI tools themselves are becoming almost spamish, right? And you got to cut through the noise, at least to figure out who do you want to talk to before maybe you get into more deeper due diligence.
Yeah, I agree, Robert. I mean, like I don't respond well to AI generated results, especially on the reach out. I prefer, the individual response, and I will test people on that. Like you said, I think going back to the question from a diligence perspective, I think there is some caution, and which is good because of the amount of sensitivity around documents and things that are in the diligence process, especially on, say, the M&A side of things. You got to be real careful. And I think there are some companies, hopefully, that are, coming out of the startup ecosystem that will address that. But just having a company say, oh, now you can, do this with AI. I don't just naturally trust that and go, great, I'm going to upload 2,000 diligence documents and have you write me a summary. I don't know where those documents are going, right? So you do have to be a little bit cautious still because of the security and all the other issues associated with the information. But I think you can get a lot out of it. You can learn, what can I summarize? What's safe to maybe look at? How can I apply an algorithm that's coming out, to this particular problem I'm having? But you don't want to throw caution to the wind and just say, great, let me try out this AI thing and see how this deal works out.
Yeah. No, I think it's such an important point. I mean, what I've seen personally is that I think AI is super helpful for quantitative analysis, but in the land of pre-seed investing and emerging manager investing, right, where so much of it is a little bit more qualitative and sort of human oriented, that's not an area, at least that I've seen yet, where AI can really be that helpful. Anyone have any last questions? Otherwise, we can close things up. But if anybody wants to raise a hand, ask a last one, we've got another minute or two to allocate for that. All right. Well, if there are no brave souls, we will close out. I just want to thank all of our panelists for joining today. This was a really awesome discussion. I feel like I learned a lot. And it's always fun to have, kind of multiple sides of the table all on a single panel, so to have sort of professional LPs, individual LPs, GPs with Sarah. I think it's just a really unique sort of lens on everything that's happening in the market today, which is a lot. It's hard for anybody to keep up with. But thank you so much for participating. To the audience, thank you so much for joining us today. And we'll see you soon. Thanks, everybody.
Thanks. Bye, guys.
Thank you.